Brad Williams, Frugal Finance, Irrevocable Life Insurance Trust, an ILIT. Reasons to consider an irrevocable life insurance trust. An irrevocable life insurance trust is a legal entity established during an individual's lifetime designed to own and manage life insurance policies. The trust governs the distribution of policy proceeds upon the insured's death in accordance with their preferences. By transferring ownership of life insurance policy to an ILIT, the policy's benefits can be shielded from estate taxes as the trust is generally irrevocable once created. Key points: an ILIT holds and controls a life insurance policy while the insured is alive. It manages and distributes the policy's death benefits after the insured's passing. The primary parties involved in an ILIT are the grantor, trustee, and beneficiaries. ILITs can reduce estate taxes, avoid gift taxes, protect government benefits, and provide asset protection. How an irrevocable life insurance trust works? An ILIT involves several key participants: the grantor, who establishes and funds the trust; the trustee, who manages the trust; and the beneficiary, who receives the benefits. Once the trust is funded, any transfers or gifts made to the ILIT are permanent, and the trust cannot be modified or revoked. It is essential that the grantor avoids any incident of ownership in the life insurance policy. Premium payments should be made from the trust-owned bank account, not from the grantor's. Additionally, if an existing life insurance policy is transferred to an ILIT, it is important to be mindful of the 3-year look-back period, as this could result in the death benefits being included in the grantor's estate. For individuals seeking coverage, it's possible to apply for life insurance and designate the ILIT as the owner once a policy is offered. This ensures that the trust is listed as the owner before the policy is issued. Once established, an ILIT can serve multiple purposes, offering various advantages for estate planning. Reasons to set up an ILIT: reducing estate taxes. A major benefit of an ILIT is that it can reduce estate taxes. If an individual owns the life insurance policy, the death benefit becomes part of their estate and may be subject to estate taxes. However, when the policy is owned by an ILIT, the death benefit is excluded from the estate, reducing the potential estate tax burden. Avoiding gift taxes. Contributions to the ILIT can often be made without triggering gift taxes. To avoid such taxes, the trustee must notify beneficiaries of their right to withdraw contributions within a specified period. This makes the trustee eligible for the annual gift tax exclusion, which allows for a significant amount to be gifted without needing to file a gift tax return. Protecting government benefits. For beneficiaries who rely on government assistance programs such as Medicaid or Social Security disability, an ILIT can ensure that the life insurance proceeds do not disqualify them from receiving benefits. The trustee has control over how the funds are distributed, allowing for careful management of distributions. Asset protection. Life insurance policies held within an ILIT can be shielded from creditors. Depending on the state's laws, the death benefit and cash value may be protected, though creditors may have access to any distributions made from the trust. Managing distributions. Trustees can have discretion over when and how policy proceeds are distributed to beneficiaries. This allows the grantor to specify conditions or milestones for distribution, such as after significant life events or when beneficiaries reach certain ages. This is especially helpful in blended families or when the beneficiaries are minors. Legal planning. An ILIT can help avoid the generation skipping transfer tax, which applies to transfers made to beneficiaries who are more than one generation younger than the donor. By using the life insurance within an ILIT, the grantor can ensure that multiple generations, including children and grandchildren, can benefit from the trust assets without incurring estate and GST taxes. Tax consideration. ILITs have their own tax identification number and income tax structure. However, the cash value of life insurance policies held in the trust and the death benefits itself are typically free from taxation. In certain cases, the trustee can access the cash value of the policy during the grantor's lifetime through loans or distributions, although any income earned by the trust could be taxable. Drawback of irrevocable trusts. The primary disadvantage of an irrevocable trust is its permanence. Once assets are transferred into the trust, they're no longer under the grantor's control. This could create issues if the grantor needs access to those assets later. In some cases, however, a court may allow the dissolution of the trust under certain circumstances. What happens when the grantor dies? After the grantor's death, the ILIT continues to function according to its terms, collecting and distributing the life insurance proceeds to the beneficiaries as planned by the grantor. The trust ensures that the death benefits are used as directed, providing financial support to the beneficiaries. Purpose of an ILIT? The primary objective of an ILIT is to reduce the taxable value of an individual estate, helping to minimize estate taxes on the life insurance proceeds. Additionally, it provides a safeguard for assets from creditors and can be used to support long-term financial planning goals. Final thoughts? An ILIT can be an essential component of a well-structured estate plan, helping to manage life insurance policies in a way that maximizes benefits while minimizing tax liabilities. Although the federal estate and gift tax exemption are increased, many states still impose estate taxes on estate values well below the federal threshold. As such, an ILIT remains a valuable tool for wealth management and legacy planning. If you're looking at including an ILIT into your estate, contact an estate attorney. If you have any questions about how an irrevocable life insurance trust works, comment. Brad Williams, Frugal Finance. Thanks for watching. Hope that helps. See you soon.